Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thanks for tuning in today. For those of you joining The Brew for the first time, we like to start the Brewcast by celebrating today's National Day for February 17th. Today is National Cabbage Day. This delightful garden staple provides some of the best recipes for the upcoming Celtic holidays. Cabbage comes from the French word caboche, meaning head, and was brought to the Americas by French explorer Jacques Cartier. Today, bring out your favorite cabbage recipes. Wrap up pigs in a blanket or eat cabbage fresh. And if all this talk of cabbage has you doing an Irish jig, go right ahead, no judgments from us. Today on The Brew, we have Eric Christopherson, who is an estate and business attorney. He's not only a friend of ours, but a highly respected resource in the estate planning community. Eric serves as practicing attorney and managing shareholder at Grams and Christopherson, which has many locations throughout Greater Wisconsin. This Brewcast is the second part of a series titled Trusts Uncovered. Eric will share the many trusts available for our use, highlighting their benefits and proper ways to implement the various trusts. This Brewcast will likely go over 15 minutes. We just can't help ourselves. We're so gosh darn curious about trusts, and we have Eric reserved. But don't worry, if you have to hop off, we do actually record these Brewcasts, and it will be posted on our YouTube channel later today. Take a look at the chat box below. I'll be keeping a lookout while Eric is live for your questions and comments. Also, the entire audience is in a drawing for a free continuing education course, and we'll be announcing the winner shortly. Thank you for tuning in, and without further ado, Eric, welcome. The mic is yours.
Yeah, thank you, Abby. Thank you for having me. I'm excited to be here again this week. And for those of you who didn't tune in last week, that's perfectly fine. This is our second segment of our Trusts Uncovered presentation. So I'm just going to go ahead and share that presentation here on the screen with you. But last week was mostly introduction to trust and then discussion of some of the more basic trust planning techniques. And then this week, we will go over some of the more advanced techniques. So that's kind of what our agenda is for the day. And here, let me turn this presenter on. So yes, Trusts Uncovered, Part 2. And so this is part of the advanced planning series. And, like I said, today I'm excited because we are going to, sink our teeth into a little more advanced concepts here. But as I mentioned last week, we still like to try to convey these concepts in a manner that is understandable, even for a newer advisor, but at the same time, will provide that enhanced benefit to more veteran advisors. And, this one will be more focused towards the experienced end, but also we'll still try to at least introduce these concepts at a more simple level, just so that people can at least get familiar with the concepts if it's something you're not familiar with. If it is something you're familiar with, it's good, because then we can build on your foundation you already have. So don't need to do too much of an introduction to me. Abby already gave me a great introduction. One thing I always just be sure to say whenever I'm giving one of these presentations is I am a local Wisconsin-based estate planning attorney and have high regard and respect for financial professionals. And so I always extend the courtesy of letting anyone know who watches me that if you do have specific questions or situations that you want to run by a local experienced estate planning attorney, my door is open, my email, my phone is open for those sorts of questions. And I'm always happy and excited to collaborate with real life situations that do come up for the on-the-ground professional advisors. So just want to say that. But then moving into the specifics of our presentation today. So today we're going to talk about advanced trust techniques and, some context as well on each of these strategies as far as when would you use this, what might be a situation to look out for where this might be a recommendation for a client, and then also what's the tie-in with the financial plan for a client who does some of these strategies. So we'll talk about credit shelter trusts and estate taxes, and then also irrevocable life insurance trusts, and also give you kind of some information on the climate of where things are at right now from a legal standpoint as far as estate tax law, and where we see these things being used right now, where we see them being used in the near future, that sort of thing. And then lastly, we'll finish up with charitable trusts and some specific strategies where you can be on the lookout to utilize these techniques. So that's our agenda for the day. So to start off with, I want to just give you guys a general primer on estate taxes as far as not just where we are right now, but where we've come from, because I think that's very helpful in understanding the policy behind this, as well as some of these techniques are used to mitigate estate taxes. So knowing where things stand is very helpful. What's not helpful that I hear sometimes is just, oh, well, the exemption is $11 million, so we don't need to worry about it. That's obviously not helpful. So giving you a little more context, going back to 2001, and that's a typo there on my slide, those numbers are inverted. It's 675,000 is what we were sitting on an exemption just 20 years ago. So it's incredible to think about the immense amount of change that has occurred in this area in the last 20 years, where literally 20 years ago, we were sitting on a $675,000 exemption. So anyone who owned a business, who owned farmland, who had significant investments, they were at risk to estate taxes. And that obviously is not the situation we're in right now. But if you follow things at a national political level, we've been at a very generous tax situation for the wealthy for some time, and the commentators are feeling very much so that we're now going to be taking the swing back the other way. And everything is an ebb and flow, as you know, and so that's something to definitely keep an eye on in the future. Certainly within the next 10 years, but even in a shorter time frame than that, I believe. So basically, just to kind of give you the 2-minute version of this whole slide. There's a lot of information on this slide and a lot of history on this slide. But basically, George Bush came into office. The exemption was $675,000. His big tax reform was to gradually increase that exemption over the next 10 years. And that's what happened from 2001 to 2010, is we saw the exemption go from 675 to $1 million to $2 million to, and then in the final year, it went all the way up to $3.5 million. And that's essentially what happened under George W. And then Obama came into office. Everyone was incredibly scared that he was going to have this be one of his major initiatives, is to go after this tax, and that never happened. As we know, and have the benefit of hindsight of, is that he was more interested in Obamacare and those sorts of reforms, and quite frankly, actually allowed estate taxes under him to increase even further, which certainly wasn't predicted by anyone. But under Obama, we actually had the exemption raised from $3.5 million up to $5 million, and so that obviously was done legislatively, but also as compromise for other things. Is okay, we'll leave this estate tax alone, to focus on other priorities. So and then we had in there too the crazy, the craziest time was in that 2010 range, where literally the estate tax went away for a year, which again, everyone predicted there's no way Congress is going to let the estate tax go away, and they literally let it lapse for a year. So there was a year in there that they did not collect estate taxes at all, which obviously that is not good policy to just have it totally drop off. But that's sometimes the level of attention that this tax gets, is that it unfortunately is an afterthought. But for the estates, for clients whose estates this may affect, this is anything but an afterthought. And so it's kind of discouraging to see the lack of coherent policy behind this. If you see it going from 675, up to 5, or up to 3.5, and then suddenly it just disappears for a year, suddenly it comes back at 5. Then you get Donald Trump coming into office, and as part of his tax reform, he doubles it from 5 to 10. And in all these numbers, post Obama, Trump, they're all indexed for inflation too. So I'm just using 5 and 10 as even numbers, but at this point, they're all tied to inflationary indexes. And the bottom line is that right now, the exemption is at least more than double what it should be, from any kind of a healthy trajectory and from any kind of policy standpoint. We believe that the exemption actually likely should be more in the $3.5 million range. And that's something that is leaps and bounds different between, do you have a $3.5 million exemption, or do you have what we currently have, which is an $11.5 million exemption. Those two numbers are immensely different when you're talking about working with upper middle class families and business owners and farm landowners and so forth in Wisconsin, where 3.5 would be a real threat to many estates versus, you start taking it up to 11, it's a very, very small group that you need to deal with. So, so for many of our clients, we're looking at, by and large, how does this affect the people in the $3 to $5 million range? Because that's more of the people that we deal with on an ordinary basis. And so from that standpoint, we think that those people definitely do need to keep an eye on things. Number one, we know that this double that Donald Trump did is automatically going to go away in 2025. So even if no one wants to touch this and everyone just stays away from it, we know that we're going to be sitting on, as of January 1 of 2025, we're going to be sitting on that same 5 million indexed for inflation. We're not going to be on the 10 million anymore. That's going to just automatically go away per the legislation and per the sunset terms that were in Trump's tax reform. So that's not going to be permanent, and definitely should not be counted on as permanent. But even then, with many of the programs that the government is looking to implement now, and depending on which direction our country goes, there's a lot of talk of, these programs like Medicare for All, or Green New Deal, some of these climate change reforms. So any of these things are going to require massive revenue generation by the government, and they're going to be looking towards all sources. And obviously, this is one source that the policymakers who favor expansive social programs are going to have no qualms at all about taking the taxes from this group. And so that's something where I do believe legislatively there's going to be some extra taxes levied, even if we do naturally just go back down to that 5. I think there's going to be a push for making that go even lower, as well as for instituting other types of taxes on estates and on income, and trying to go after additional sources of revenue. So I believe this is something that's very relevant to stay on top of, because the planning techniques that we're going to talk about are going to become even more relevant in this climate that we're about to enter into. Like I said, we've been in a heyday, especially with Trump excessively doubling that number that was already slightly inflated. That's come to an end now, and the pendulum's swinging back the other way. So this is something that advisors need to be aware of, and advisors need to do a good job of helping educating their, the upper end of your book of business about the threats that are coming. So, so that's the landscape that we're under. I know that was a little long-winded there in and of itself, but I think that type of information may even be more helpful than the specific techniques. So I just wanted to let you guys know where I'm coming from, what kind of background I'm coming into this with. And this is something, obviously, I've studied very heavily my entire professional career, because from the estate planning side, it impacts very greatly what techniques and what things we use. And like I said, everything is cyclical, and certain strategies that we were doing very aggressively at times get put on hold at other times, and then get re-implemented when things swing back the other way. And that's exactly what we're seeing, specifically with this first strategy of credit shelter trusts. So credit shelter trust, what that is this is going to typically be implemented in a married couple's trust, to say that in the event the first spouse dies, we're going to set aside or shelter our credit into a separate irrevocable trust, oftentimes called a family trust, just more generically, set aside some money for the family, so that we can, the purpose of this trust originally was so that we can utilize two exemptions, utilize both spouses exemptions, the first to die and the second. Because if you didn't have this type of trust, the former law would say, okay, then the surviving spouse only gets one exemption. Well, the other thing that, and this was actually under Obama, the other thing that came under the estate tax changes in that era was they did actually allow for what they call portability of an estate tax exemption. So what that means technically is you no longer need a credit shelter trust to take advantage of two exemptions. You get that by doing what they call electing portability. Now, that doesn't mean that credit shelter trust should never be used, but I largely believe that credit shelter trusts in estate plans, at least in a middle class, upper middle class affluent market, should use credit shelter trusts only as a disclaimer or optional method by and large, and should typically not have those used as a mandatory funding or a formula clause that says fund this credit shelter trust with the maximum. So that's something that has been on our radar for some time now, since really since the Trump tax reform of doubling it and making that exemption go so high. There's not a lot of need for having the credit shelter trust, especially considering that portability is an alternative option to the credit shelter trust. Obviously, portability doesn't provide trust protections. It doesn't protect from a spouse spending the money or from getting remarried. So some of these other family concerns that a trust is good for, a trust is still good for that. So the family trust, if there are concerns within the family of asset protection, those trusts are still good and necessary for that. They're just not necessary really for the estate tax aspect anymore, because there are other things you can do to mitigate that. And even then, the mitigation is not as required because the exemption is so high.
Thanks, Eric. And we've got a question from the audience. Can you explain a little bit deeper on the word disclaimer?
Yes, I'd be happy to. So disclaimer technically, legally means to refuse to accept an inheritance. And so the technical way that would be done in a trust is you would set up your trust to say, I leave all my assets to my surviving spouse, except that they may disclaim or refuse to accept any portion of those assets at their choosing. And then whatever portion the surviving spouse chooses not to accept, not to receive in their own name, instead get redirected into this credit shelter trust. And so it's a way of utilizing a disclaimer to have the funding of that credit shelter trust become optional. The downside, again, to that type of thing is it does require the surviving spouse to proactively make that disclaimer, and does require her to seek advisement from her financial and legal advisors about whether or not that disclaimer is a prudent action to take. And that has to be done within 9 months after the first spouse dies. So there are some timelines that the IRS sets relative to when you can make a valid disclaimer. But the concept of disclaimer, as I said, is just refusing to accept an inheritance. But this is how it is proactively used and written into an estate plan to say that the trust specifically has that wording already in there. And that's the only way it would work, is if the trust has written in there this special language that says, if my spouse disclaims, instead, the inheritance shall go to this credit shelter trust or family trust. So that's the language, has become very popular, I would say, even in the last 10 years, funding trusts in that way, rather than doing this, as I called the opposite, or the other method would be mandatory funding, which says my credit shelter trust shall be funded with the maximum, which that would result in, under current law, with an $11 million exemption, that would result in the entire estate of the first spouse to die being funded into the credit shelter trust. And that's not what most families want, because they want some assets still going under the control of the survivor. So those maximum funding clauses are actually very dangerous, in that they may not properly reflect the couple's intent, and that they don't intend for the full estate to go into into the credit shelter trust at the first death, but that's what some of these clauses in old trusts do say. And so that actually is a great segue into the final point on this slide, which is the non-judicial settlement agreements. And so this is actually, we're doing a lot of these to undo credit shelter trusts that people have currently, but they don't want. So this would be as if you did have a mandatory funding credit shelter trust, or, you're sitting on an estate that's maybe, a couple $1 million and it's in this credit shelter trust, and you just say, hey, I don't want this anymore, primarily because it's an inconvenience to have, but also the biggest reason is assets inside this credit shelter trust do not receive a step up in basis at the second death. So one of the tax strategies that we're doing with our clients who have credit shelter trusts but don't really need them is actually getting together the children and the surviving spouse as a family, because it's a family trust, and saying, hey, does it make sense for us to get rid of this family trust and put these assets back into mom's name? And then when mom dies, the kids will still inherit all those assets, except they'll inherit them now with a fully stepped up basis. So that's the one thing to always consider when you're planning for estate taxes is the step up in basis and the avoidance of capital gains tax is on the opposite end of the spectrum as the avoidance of estate taxes. And so you always got to pick and choose which one do you want. And so it just so happens under the current climate, we're choosing, because our estate tax exemption is so high, we don't need to choose estate tax protection. We're already protected from that based on the high exemption. We are going to instead protect ourselves against those capital gains taxes and make sure that we get the step up in basis on those assets. So a non-judicial settlement agreement is just basically a contract between the beneficiaries of that family trust, the kids and the surviving spouse, that just says, we all agree just to get rid of this trust. And that's something that we are actually authorized to do under our new trust code, which I love, because it used to be you had to take that to court, file a lawsuit, have a judge decide whether or not you'd be allowed to do this or not. Under our new trust code, that new process is just, as long as all the parties sign a contract agreeing to do it, that contract will be enforceable. And it's done completely outside of court, hence the word non-judicial. And it's just an agreement between the parties. And so that's something we are doing a lot of now, to actually get rid of irrevocable trust that we don't want anymore. So that's something just to keep in mind, not just with the credit shelter trust, but just in general. It's a great planning tool that we now have at our disposal.
And that tees up this question beautifully from the audience. With the NJSA, is there any need to decant trust?
Great question. The answer is no. This would be a replacing of any kind of decanting. This is basically just saying we're going to have an agreement to terminate the trust, and the agreement would be treated the same way that a court judgment would be treated. So very oftentimes it's completely tax neutral, and it just has a settlement for the division of how are these assets going to be distributed. So the great part about it is you don't need to do decanting. You don't need to do any kind of arrangements with the trust. When we've done these, essentially you have the signed agreement, and that is your court order to move the assets. And so once that agreement is signed, that can be presented to the institution holding the assets, and the assets can simply be, if they were in an irrevocable trust registered under a trust tax ID number, you simply re-register those securities into the individual's name, and it's not a taxable event. And so it's a great tool that is much more streamlined, where previously most of the times our advice used to be that it's just cost prohibitive to have this go to court, as well as you don't ever know if a judge is going to sign off on what you're trying to do, because for the most part, it's not that the trust is wrong or defective. It's usually just we're trying to take advantage of some tax opportunities, and you never know based on the leanings of a judge whether or not they'll think that's a good reason to change a trust or not. Now anymore, it doesn't matter whether the reason is good, bad, or otherwise, as long as all the parties to the trust agree to it and you do it in that written contract. You don't have to worry about a judge. You don't have to worry about decanting. You don't have to do any of those processes. It's just this non-judicial settlement agreement, and it's a whole new statute that has its own processes outlined, but its processes are much simpler and streamlined. The biggest obstacle just being that you do have to involve all the beneficiaries of the trust in this, so that if you're dealing with some second marriage type situations, it's probably not going to be feasible when you're talking about if it's talking about between a stepmom and her children, as
Sure.
opposed to a natural mother and her children. This would be very easy for. Not to say that it can't work in those blended family situations, but it has another layer of complexity relationally when you're dealing with those types of situations.
Thanks, Eric. Additionally, is this available in all states or just Wisconsin?
It's available in many states. It's part of the initiative under the new Uniform Trust Code, which Wisconsin has adopted here within the last 5 years or so. But not all states have that, so you would have to evaluate under a state-by-state basis, and that's where you typically want to seek counsel of a local attorney in the jurisdiction that the trust is. Now, I will say is the other thing that's great with modern trust law is you can move trusts. So if you are in a jurisdiction that is not favorable I've had trusts in other jurisdictions, and all I got to do is move those trusts into Wisconsin, and then I can do a Wisconsin non-judicial settlement agreement for them. So it's and moving a trust again is just signing documents too and changing the situs. It's not a long ordeal. And it's something that something you'll want to get specific legal advice on, but something that it is possible in many jurisdictions.
Thanks, Eric. Those are all the questions from the audience.
Terrific.
Please continue.
All right. Well, sorry, I know I'm getting long-winded here. I'll try to pick up the pace here and move us on to the next topic. The one final note on this, just again, that I didn't mention, that is always one of my pet peeves that I have to mention, is that when it comes to electing portability, the one thing that's most frustrating to me when I hear this sort of topic discussed is that portability is an election that has to take place. It's not something you get automatically. So a lot of commentary I read about estate taxes that's more layperson driven is written basically talking as if spouses automatically get 2 exemptions without doing anything. That, oh yeah, we just take for granted the husband has his exemption, the wife has her exemption, and that's just automatic. You don't have to do anything. Well, that's simply not true. The fact is that you do have to do something, and it's the same thing where within 9 months after the first spouse dies, you actually have to file a full and complete estate tax return. And on that estate tax return, there's a checkbox that says, I elect portability. So that's the piece that is missing that many people don't realize. And again, because it's time sensitive and because it has to be done within 9 months of that first spouse dying, it's something that I'm highly concerned that some people might miss. And then they're sitting on only 1 exemption instead of 2. So then if the exemption does go down to, 3 million or 2 million or something in that range, that could be very, very crucial for our clients, whether or not they're getting 2 exemptions or 1. So even in that, net worth range, that 2 to 5 million, we're still recommending those levels of estates elect portability just to make sure that they do get 2 exemptions. So it's something that you do have to take a proactive action within 9 months by filing a full and complete estate tax return, something that is very often overlooked or glazed over in the things that I see. So that's my last soapbox on portability and on estate taxes and advising clients about that area. So the next thing, you guys are probably pretty familiar with, I won't spend as much time on. It's another technique that we use to help mitigate estate taxes. So all the stuff we talked about previously in terms of the rationale for why you would do this, again, these were very popular when the exemptions are lower. So this is something that in the insurance industry, you're going to see pick up more as the estate tax exemption goes down, ILITs go up. So this is called an irrevocable life insurance trust. The basic concept being, for those younger agents who might not be familiar with this, is that life insurance, as you know, is completely income tax free. But by default, your life insurance is included in your federal estate tax gross taxable estate, meaning that you have to pay taxes on it, and it counts towards that total. So the point here is that in order to have your insurance not be part of your estate, you need to put it in an irrevocable trust. Hence the term irrevocable life insurance trust. It's an irrevocable trust to hold life insurance and to keep it outside of your estate, so that when that death benefit comes into the estate at death, it is not included as part of your federal taxable estate. So the trick with this is that to get the premiums into the trust, the premiums would be leaving your estate, and those would also be gifts. So you need to make sure that the premium payments qualify for annual exclusion. And annual exclusion I have listed up there is $15,000. That's the present amount that any individual can give to any other individual and have it not count towards their lifetime gift tax exemption. So it's basically everyone gets to give that first $15,000 per person for free. So conceptually, how this works with an ILIT is for each beneficiary of that ILIT, you can have up to $15,000 go into that trust each year. And so this is where when you're designing a policy and you're looking at how much annual premium can you get in there tax-free, you can basically get $15,000 per beneficiary of premium in there tax-free, so that it doesn't affect gift taxes, doesn't affect estate taxes. And the kind of legal fiction about how you do this is called a crummy notice. And again, that's just from the case of, Crummy v. IRS, where the person wanted a ruling from the IRS asking that this was okay to do. Basically, a crummy notice is just when you put that $15,000 in for the beneficiary, you actually have to send them a letter in the mail that says, I put $15,000 in this trust for you. You can take it out if you want. The idea being, don't take it out because we need that money to pay the premiums on the life insurance policy. But technically, the beneficiary has to have the right, and they have to be notified of that right via a crummy notice that they have the right to take it out. Long and short of it is, this is all just a process whereby you can qualify for that annual exclusion to have the entire ILIT be completely gift tax free and completely estate tax free. So it's something that, you want to generally be familiar with that concept. Obviously, the attorney or the trustee of the ILIT is actually who's going to be the one carrying out all of this, but it's important to understand, especially when it comes to, premium design and that sort of thing, as far as how impactful can this trust be and how much money can we get into it without incurring any taxes. And then, of course, with the design of the policy, I won't get into that too much, but obviously these ILITs are going to be holding life insurance policies. Oftentimes, we're just looking at a second to die policy because estate taxes are not owed until the second death. And you're looking at just getting a policy that is permanent and guaranteed, so that the death benefit will for sure be there at the end of the day, because that's, again, we just want to make sure you get the most death benefit for the most money. But these can still be used with products that do build cash value as well. The grantor typically cannot be given the right to withdraw that cash value, but that's where they can put in what we call SLAT provisions, or spousal lifetime access trust provisions, where the spouse of the grantor can actually take the money out. So that's a way that you can still use this as a strategy to build wealth, yet still have access to that wealth if it's going to be used with a permanent policy that does have cash value. Otherwise, you may be looking at some type of universal structure where you're literally just trying to get the most guaranteed death benefit at the second death, second to die, for the least amount of premium. Again, it's going to depend on what the client's goals are with setting up this trust. But the point is whatever their goals are, you can make that work as long as you're working with a good attorney who takes that in consideration and can draft those provisions into the trust.
Thanks. Another question from the audience, Eric. You're mighty popular today. Question regarding the annual exclusion. How does that increase? Is that annual, indexed to inflation? Does Congress decide? If you could speak on that.
Yeah, it is indexed to inflation, and it is determined on an annual basis by the IRS. Same thing with the estate tax exemption, how it was, 11.58. The IRS will basically publish a revenue ruling that says for this year, this is what the annual exclusion is, and this is what the estate tax exemption is. But yes, it's indexed for inflation. They do round it off though to the nearest thousand, so that you're not dealing with annual exclusion numbers that are okay. The annual exclusion this year is $14,958. You're basically going to get a round number, which is why sometimes you see, okay, it's 15 this year, it's still 15 next year, and then it might be 16 the year after that. So the bottom line is that it is indexed for inflation, but it's also rounded so that the easiest and best way to always know is just to check what the current IRS revenue ruling is that says this is what the exemption is for the year. So they do actually publish that so that it's not something that people have to calculate and figure out on their own. The IRS does those calculations, they do the rounding, and then they say this is exactly what the exemption is. So that is something that is publicly available. So then moving on then, so that's what I wanted to say about ILITs. One final thing on ILITs. Again, this is for probably more advanced, but good for you to know also. Oftentimes, there are concerns among, again, advanced practitioners and people who are experts in life insurance sales for estate tax mitigation are aware of this, but it's something that, when you're growing your practice or wanting to become an expert in that area, it's important for you to know there are rules surrounding two different concepts that you're going to want to be aware of. One is called transfer for value, and one of them is just there is a 3-year rule that says if you move life insurance out of your estate, the government comes and claws it back if you die in the 3 years after you transfer that policy. Well, the good part with, again, become familiar with those issues if you're dealing in that market where you're selling policies for this reason. But also the important part is to work with a qualified attorney who knows what they're doing and can set up your trust properly such that it be considered a grantor trust. Again, that's going to get you around that transfer for value problem, for example, because if a policy is going from an owner into a trust, if the trust is a grantor trust, that is actually deemed not to be a transfer at all. So, same thing for the estate tax mitigation. If you're setting yourself up as a grantor trust, you can get around some of these rules that might be of concern. So it behooves you to know what the rules are that you're trying to get around. So again, it's beyond the scope of our presentation today, but the 2 things I would encourage agents to read up on, at least, to be dangerous of, is the transfer for value rule, as well as the rule for estate tax inclusion for transfers of life insurance within 3 years of the date of death. And that would just be under under Internal Revenue Code. It'd be 2030 something. But regardless, those are the two things that you want to be able to talk intelligently on, and I'm sure your companies have some great resources on if you start getting into this area, which I think that, like I said, my future outlook is that there's going to be many more opportunities in that marketplace going forward for actually having another golden age for ILITs, like what we were seeing in the early 2000s. That could very well be coming back, in the 2020s or certainly 2030s. So something to be aware of as you are building your practice for the future, for sure. The final segment for today, and I know we've run way over here, so I'm gonna just introduce this concept at a basic level. And again, it's something that I'd be happy to provide more information on individually if you have clients that want to discuss these concepts. But the final concept that I want to introduce is just charitable split interest trusts. So these are called charitable remainder trusts and charitable lead trusts. Again, without getting into too much detail, just the basic difference there is a charitable remainder trust sets up an annuity stream, and then the charity will get the balance of the asset at the end of the day, versus a charitable lead trust is the opposite. It sets up an annuity stream for the grantor, where the grantor will receive income for a term, and then the charity, excuse me, I said that backwards. Charitable remainder is that the charity receives the remainder, and a charitable lead is that the charity receives the annuity and the grantor receives the remainder. So it's kind of just, in the name, is the charity getting the remainder or is the charity getting the lead? So sorry, I bumbled up myself there even, but like I said, look in the name, it identifies which segment of that split interest the charity gets, and just understand that there's a lead, which is an annuity payments for a term of years, and there's the remainder, which is the balance after that term of years. So where these are used, again, very important to know, largely just, okay, who should I be targeting that might be interested in this type of strategy? And the biggest thing is when you're looking for someone who has a big tax burden that is going to fall all in one year, and they're looking for a way of how can I mitigate that big tax burden? And when I say tax burden, I mean just income taxes. So events that we typically see that people are doing this is they sold some rental real estate and didn't do a like-kind exchange. They want to get out of it, and they sold a bunch of rentals or apartment building or whatever. They've got a big capital gain, big depreciation recapture. Or business owners who just sold their business and got a huge check, and they benefited from the business they built, but now they're about to get smacked with again a huge tax. Or even people doing a large Roth conversion where they're liquidating, or not liquidating, but rolling over money from their IRA into a Roth, and then bearing the taxes born with that. So anytime you have a huge tax burden for income taxes in an individual tax year, within that same tax year, you can set up a charitable trust, and whatever contributions you make to that charitable trust are deductible, so that they can be used to offset that big income event. So this is where, again, you'd want to figure out the client's goals is, are they just looking to get rid of that income tax burden? That's usually the primary goal. But then from that, if they sold their business, do they need this to convert into a retirement income stream? Again, if they do, that you'd be looking at a charitable remainder. Make sure that the charity gets the remainder and that the client, the grantor, gets that income stream back under those annuity payments. So it's something that can structure in that way. And then with the other type of strategy, with the charitable remainder trust that we typically do, that I've listed here, again, something to read up more on, probably, again, outside the scope, just in terms of complexity of what we can cover here today, is what we call a wealth replacement trust. This is a specific strategy that I'm always very excited about, especially to talk to people in the life insurance industry, because the idea here is you set up a charitable remainder trust. You get that nice big deduction today, even though the charity is not going to get the remainder until your death. And then the annuity payments that the client receives back, because again, when the charity receives the remainder, the client receives the lifetime annuity payments. You take those lifetime annuity payments and you design a life insurance policy. The idea being that the remainder that is now going to charity, well, what if I want to replace that and I want to make sure my kids also get that wealth? You basically take the annuity payments that the client is receiving under the charitable remainder trust. You match your annuity payments so that they can cover premiums under a life insurance policy. And then that life insurance policy will provide tax-free death benefits to the children at death. So essentially, you are giving the money to the charity at death. You're giving that much or more to the kids through a life insurance policy death benefit. And then the annuity payments are paying the premiums. So the client doesn't need to outlay any more cash other than what they already put into the charitable remainder trust. And as I said, they still get that huge income tax deduction for the initial contribution into the charitable remainder trust. So it's a very synergistic strategy where one part of the strategy runs the other part. And so that's something too that, typically, again, it's just a trade name for it. It's typically called a wealth replacement trust or a wealth replacement strategy. It's basically the combination of a charitable remainder trust and a specifically designed life insurance policy to synergize with that trust to help the client meet their objectives of leaving money to charity and leaving money to their children and having no additional premium outlay and getting that immediate income tax deduction. So that's a really cool tool that we like to have in our belt and that we like to help educate advisors on. So I'm gonna end it with that. There's certainly more we can talk about with charitable remainder trust, with diversification of assets, and with using this for highly appreciated assets, because again, these charitable entities don't pay income tax. So it's really great for if you need to diversify or get out of a highly appreciated concentrated position of one particular asset. But again, that'll be outside of the scope today. At some point, we could do a whole seminar just on charitable trusts. So I know I've gone way over here, so I'm gonna stop talking and
Eric, the questions are still streaming in, so thank you. And also I put stars next to wealth replacement trust. You are speaking our language. Thank you. This from the audience, final question, and then you can take a drink. Is it a good idea to make a trust the beneficiary on an IRA?
Great question. So that I will try to answer as succinctly as possible. The answer is sometimes. If you hear someone says you should always do it, they're obviously wrong. If you say someone says you should never do it, they're probably wrong too. But the important thing to know with trusts and IRAs is that law did just completely change only a year ago. That was actually January 1 of 2020. They changed the rules with respect to stretch IRAs. So it used to be that inherited beneficiaries could stretch an IRA over their entire life expectancy. That is no longer allowed under the new law. We know now that they can only stretch over a 10-year period. And so that's, again, irrespective of utilizing trusts, it's only a 10-year period. And so it used to be that we'd be looking at more of a lifetime strategy with respect to how that money would be paid out. We now know we can't look at that. But what we can still do is you can still provide those beneficiaries with lifetime inheritance protection if it's a goal to have the inheritance protected. Again, that's going to be irrespective of taxation. It's going to be important that, again, in any case, that you're identifying both of those goals as far as what's driving the client's decision. Is it just a tax question, or is it a trust asset protection question? And sometimes those overlap. But if all you're looking to do is maximize IRA distributions, our specific thought is, and again, this is something important for advisors to know, when you're advising beneficiaries of inherited IRAs, is the new 10-year rule is very different from the old lifetime stretch rule. The old lifetime stretch rule, you would take MRDs, RMDs, required minimum distributions, over even balance over the inheriting child's life expectancy. This new 10-year rule, what's very unique about it is you do not have to take any minimum distributions other than it has to be completely liquidated within 10 years. So I believe that there is a huge opportunity here for financial advisors and legal advisors to advise clients on how do I properly take this IRA over the next 10 years. It's a great way to get in with the kids who inherited that IRA and give them that advisement, because they're going to have no idea. And the fact is it's going to depend on what are their cash needs, what's their income tax bracket. And from all of that, you can design for them. There's going to be very complex computer modeling on this, but you can design a general strategy of, okay, how aggressively do we want to take this money out? Again, the whole idea being, defer. If they don't need the cash, defer as much as possible. In theory, you push it all into year 10. But then again, you've got how big is the IRA? What are the children's tax brackets? Is pushing all that tax into 1 year going to be too much? Maybe you have to spread it over 2 years. So you're taking it in 9 and 10. Maybe you have to spread it over 3 years, 8, 9, 10. But again, there can be, I foresee a whole cottage industry just on advising beneficiaries on how to take their IRAs, which again, sorry, total soapbox, total tangent, but it definitely brings up a lot of points when you start asking, how should I leave my IRA as beneficiary to my kids? The answer is you can do a trust. The only benefit it's going to provide you is asset protection. I think the real conversation to be had in addition to that is, what are the tax planning and tax saving goals? Whether you have a trust or whether you don't have a trust, those goals will remain the same. But a trust, a properly designed trust, will not hamper you from those tax goals. An improperly designed trust could result in you being thrown into a 5-year rule instead of a 10-year rule, which would not be favorable. But again, it's not as bad as it used to be. There used to be a lot of very, people raising a lot of caution about leaving IRAs as beneficiaries, because it used to be you were comparing a lifetime stretch to a 5-year stretch. That's a huge difference. Now, when you're talking about comparing a 10-year stretch to a 5-year stretch, it's still bad, but the magnitude of the harm is not nearly as large as it was under the previous law. So that's where a lot of very extreme caution was put of, don't ever name a trust because you'll be stuck with 5 years instead of a lifetime. Well, you can't get a lifetime anymore. And if you are naming a trust, make sure it's properly designed, whether that was under the old law or the new law. There still are allowances for a trust to inherit IRAs and still be treated as an individual and still qualify for that full now 10-year distribution.
Thanks, Eric. Gosh, I'm so glad we record these. And secondly, thank you for your time. I told you we were curious. So
yeah,
we really
thank you. Sorry.
it.
Well, this will be a long episode, but I really appreciate you having me and appreciate the leniency to cover topics. As you can tell, I'm very passionate about these topics. I like to talk about them. I sometimes get too long-winded, but happy to, hopefully this can be a resource out there for your advisors so that they can always turn back to it too. And if they need to know about any of these specific topics, and hopefully too, it's just also letting them know, as I said, that I'm here as a resource. If you need to run and spitball a specific situation by me, I'm more than happy to do that. And as you can tell, I'm pretty keen on spotting what the issues are, at least, and saying, okay, well, here's the key things that we need to be looking at for this particular client.
Thanks, Eric. Do you have a contact page next?
I do.
On your
so
slides?
Let me put
Let's
that
post it.
as
Perfect.
I said. So
thank you.
That's just my basic info. If you want to take that down, like I said, it's an open invitation to any advisor who's seen my presentations. That as a courtesy, as I said, I have a lot of respect for the people in your industry that are trying to get educated and are trying to better and increase their knowledge and their practices knowledge. It's something that I want to support, and I want to encourage. I want to build up, especially the good advisors who are doing things the right way, who are seeking out continuing education and estate planning education. So kudos to you for doing that. And as I said, always feel free to reach out to me. And you'd never be charged for that type of a consultation. It's just something that I do with my financial partners that I work with. So.
We'll be having you back, that is for sure. Eric, let's wrap the call by doing our drawing. Give us a number between 1 and 15.
All right, I'm going to go with 9.
9. Who's the winner? Brian Witz, congratulations, sir. Be on the lookout for an email coming your way from all of us here at E4 with a complimentary continuing education course. And thanks for tuning in today. This has been fun. Like I said, it's recorded. If you need to go back and listen to it, it'll be posted on our YouTube channel later today. And be sure to tune in next Wednesday for The Brew. We'll have Tony Lenhart of Sales Empowerment Group talking about 3 key ways to elevate your practice virtually. Thanks for tuning in. Have a great day and happy 2021.